This video is going to be different from the others. I have not prepared a bunch of charts. I'm simply just talking one-on-one to you. Might be more boring for some of you that are so used to seeing all these flickering things going left and right. But I think sometimes it's important to dive a bit deeper, to think about things fundamentally. And what I want to talk about in this video is how to think about potentially that we can't pick the perfect bottom and we can't pick the perfect top. We know this intuitively, right? We know intuitively that it's impossible to time the market perfectly. So we are off to a degree. We can't be perfect. We can't buy for the lowest and sell for the highest. But very few people actually think about the consequences from this. The consequences from this are that we have to make a decision. Do we want to, for example, when we buy, do we want to be buying before the bottom hits? So we buy a lot beforehand, or do we want to buy after the bottom hits? If we can't know exactly where the bottom is, are we going to buy before or are we going to buy after? A similar thing has to be thought when we sell. But let's stick with the buying first. There's very different kinds of consequences from this, right? When we decide, okay, we are fine to buy before we see the absolute bottom, because we don't know where the bottom is. If we're okay to buy before that, then that means we should be okay to buy several times, right? This is the dollar cost average approach. You buy in several times, and once the bottom hits, you're happy. But if it falls further, you simply buy more and more. So the consequence from this is that you have to hold over a long period of time. You need to have fundamental conviction in the asset. You're okay to simply just hold this out and to hold it over a bear market potentially. So you're making subconsciously the decision to buy even if you haven't yet seen the bottom. Another way to think about this is to say, okay, I don't want to do this. I don't want to hold for such a long period of time. I don't know if my particular asset is the one that's going to recover in the next bull run. So maybe you're buying a certain altcoin that's in, I don't know, place 100, and you don't know if that thing will still be fashionable 1, 2, 3, 4 years from now. So instead of thinking, I want to buy before the low, you could be thinking of, okay, I want to buy after we have seen the low. Because again, right, we don't know where the exact low is. So you're not buying into the bear market. You're buying once you think that the bear market has turned around. But that has a different psychological consequence, right? Here the consequence is that you're not buying the lowest, and whenever you do buy in, you will always fear that you have a certain degree of FOMO, right? That you're not buying the low, you buy afterwards, you're buying into a rally after we have potentially bounced relatively brutally, and you're fearing that maybe I'm now the exit liquidity of the people that bought all the way down when the bear market was still in full swing. So there's two very different kinds of psychological hurdles to overcome. If you're buying into the bear market, if you're okay to buy before the low hits, you should be okay to simply just see your portfolio go down in value over long term and double down and triple down and quadruple down. That's one problem. The other problem is if you are not okay with that, you should be fine to buy and have some fear when things suddenly push up. And it could potentially retrace again, right? Then you're buying into what is already a partially hyped market. That's not easy either. So that's for the buying. You have to pick your poison. You have to say, do I want to buy very often and simply just wait it out? Or do I trade the momentum? Maybe use moving averages, right? We backtest moving averages on this channel very, very often. You could take all kinds of timing methods, but when you use moving averages, for example, per definition, you're never going to buy the perfect low. The low and price will already have hit, and the moving average is simply just averaging out all the prior prices. So once the price moves above, we have already seen the bottom. And depending on how volatile the asset is, this bottom could be 10, 20, 30, even 40% below the actual lowest price, right? The current price could be 40% above the lowest price. So those are the things to consider when buying. But the same is true for selling. If the main assumption is that you cannot time the perfect top, and nobody can, you have to pick your poison. You either sell too early or you sell too late. If you sell too early, the obvious issue is that there's more potential upside, right? Let's say you sold a lot of your Bitcoin when it first crashed, so it went from 20K to 3.5K, then it went all the way back to 69K, right? This rally from 3.5K to 69K. Let's say you didn't ride it all the way to 69K, you already sold before. Let's say the prior all-time high was 20K, you sold already most of your holdings at 30K or 35K. You lost another 2x in Bitcoin, right? That's the potential risk that you run into. You can't be that greedy. You can't potentially take all the gains. And that's especially a problem if you think that the potential upside for the asset that you are going to sell is big. If you think maybe, I don't know, Bitcoin will become the central bank reserve currency and all countries will hold Bitcoin, then the upside is maybe more than just 2 or 3x from here. And then if you're selling already after the next 2x, you've got a problem, right? So that's the first issue. That's the first kind of caveat that you have. If you say you don't know where the top is, you're selling too early, you leave out a lot of upside potential. That's the thing that you deal with. That's poison number one. If you don't want that poison, you've got an alternative poison that's selling after the top. The main problem with crypto YouTube is conflict of interest. Too many YouTubers shill garbage, promote garbage, and fill up their pockets in the background. Not this channel. Instead, there's simply the offer where I share my skills, my perspectives to you, and where I also share direct access to me, where you can ask me any questions. Feel free to check it out. The premium membership link is down below. Now, selling after the top is not easy either, because you very often see your portfolio value relative to what it had been. And there is this psychological concept of loss aversion, right? So let's say Bitcoin is at 69K, then it drops to say 50 or 45K. And you had, let's say you had quite a substantial amount of your wealth in Bitcoin. Now you see it drop 20-30%. How likely are you going to sell at that point if you haven't mentally prepared yourself for that? Right? If you're now down 30% and you've got most of your wealth in crypto at that point, how likely are you going to take profit at that point and not look back at the all-time high and think, if it just was to hit again the same price, then I'm selling. Right? This is then what people tell themselves. It's like, yeah, I used to be a millionaire. Now I'm not anymore. Once I reach the million status again, then I'm going to sell. Question is, are you really going to sell at that point? If you didn't already prepare yourself that you're going to not always sell the top. Nobody can sell the top, right? Very likely, if the all-time high then get hit again, you simply just continue to ride it again and see the next all-time high. And then you're still not going to sell because you want to get this perfect timing right. That's why you've ridden this so long in the first place. So really, there's a problem with this as well. Most people don't get the exit. And that's again why I like these moving averages. They take away a lot of these emotions. You are buying in when it's not the absolute bottom, but when momentum statistically was very, very positive, when it statistically turned around, you're buying in at that point in time, and you're selling when it's not rising that fast anymore compared to what happened before, right? When the growth stops, then at some point the price will hit the moving average and you're exiting. So you never pick the perfect bottom and the perfect top in that approach, but you do follow the trends, what is, at least historically, worked relatively well. And that's the approach for the moving average, right? For the moving average, the approach is I'm going to buy late and I'm going to sell late. I'm going to buy when we've already seen the bottom. I'm going to sell when we've already seen the top. That's the idea for the moving averages. An alternative idea would be to do the exact opposite, right? To dollar cost average in, to do exactly the opposite of what the current trend is doing. Say we are currently in a bear market, you buy Bitcoin all the time, you don't care that the current momentum is negative. And then the same would be true for rising prices. You would be dollar cost averaging out potentially as the price goes up. Because then the idea would again be you want to balance out your portfolio maybe you've got different assets, you want to rebalance your portfolio, have a reasonable allocation to crypto versus the rest that you own. So you would be gradually selling off as things rise, but then also miss out on a lot of gains. So there's pros and cons to both approaches, but it's very important beforehand to pick your poison and to really think hard about what do I actually want to do. Do I want to sell early or do I want to sell late? Do I want to buy early or do I want to buy late? Because there's problem with both approaches and we never get these times right. Now, what's also very important to know is that most of the time, the bear markets, the time when you can buy, for example, Bitcoin, they last for a longer period of time than the peak prices. So what I mean by this is when you buy into Bitcoin, you can just dollar cost average a little bit every month, say, and you can do this for 2 or 3 years without any real hype phase. You can do this in the bear market, you can do this in the accumulation phase. There's no real hype. Now, when the price is elevated though, you rarely have months and months and months of those elevated prices to sell. There's only a short, brief period of time where the media is pushing Bitcoin, where a lot of new people learn about Bitcoin, where they all jump in, where a lot of new investors enter the space and where they can sell for these high prices. The high prices tend to be a way shorter period of time than the normal/depressed prices. We are for a much longer period of time in depressed prices than we are at these hype prices. What that in turn means is, if you take the dollar cost average approach, that you have to dollar cost average out with a much larger amount than your dollar cost averaging in. And because of 2 reasons. So first of all, because of the timing, right? You can say for 3 years you can buy, but only for half a year you can sell. So if you have already that relationship, then it means your selling amount on average should be 6 times larger than your buying amount, just by that, right? But then on top of that, you also have the price development, right? The price itself of Bitcoin might, from the depressed prices to the high prices, might go 5 or 10x. So in US dollar amounts, it might not be 6 times the amount that you have to sell versus buy. It might be 6 times 5, so 30 times more that you have to sell than you have to buy. So let's say every month you buy for $1,000. When you're selling, you have to sell, when you dollar cost average out, every month for $30,000. That's very important to note because most people get this wrong. They get the buying part right, they dollar cost average in, but they don't find the proper exit. And you don't have to sell everything, right? You can sell parts over time, but still selling needs to be way faster, way more aggressive than buying is. And what happens is, in the end, what happens is most people have their allocation to Bitcoin. They do this for 3 years. They have $36,000 in Bitcoin. They see Bitcoin go up by 5 times, 150K. They hold then at that time. And then they sell maybe 10K, 20K, have the remaining 130K in Bitcoin and see then that 130K go down by 70% again in the next bear market. Simply because being too greedy and not knowing that with this dollar cost average approach, you should also dollar cost average out very heavily once we see these very peak prices. And of course, nobody, again, knows exactly where the peak is. And you have to just pick your poison. Are you going to sell heavily into the rally, or are you going to sell after you've seen the peak, maybe with things like backtested moving averages? Let me know what you think about this kind of format. If you made it that long, feel free to let me know down below. A like, of course, would be very much appreciated as well. And of course, there's also the Telegram channel. Link is down below.